Hello and welcome to the Business Standard Morning Show. I am Ruchika Chitravanshi and let us take a look at the stories for the day. A war of words has erupted between Go First and aircraft lessors who want their planes back from the cash-strapped airline. While the Aviation Working Group, which represents the lessors, has put India on a watch list, the Wadia Group-owned airline has termed it as an attempt to influence an ongoing case in NCLAT, where lessors have challenged NCLT moratorium in the airline's assets. The moratorium bars lessors from recovering their aircraft. So how will this tussle between Go First and lessors impact the Indian aviation sector? Bhaswar Kumar answers.
Your summer vacation plans may have been spoiled, with the back of the envelope calculation showing that the closure of services by Go First may have led to an almost 20% increase in ticket prices on select routes, especially the busiest. Trouble began when Go First filed for voluntary insolvency before the National Company Law Tribunal on May 2nd and stopped flying from May 3rd. Some relief may now be around the corner, with Go First expected to restart flights by May 24th. This was made possible after the National Company Law Tribunal accepted Go First's insolvency plea on May 10th. The ruling allows Go First a moratorium of 6 months, during which time the airline will continue to be in possession of the aircraft that were to be taken away by the lessors. The NCLT also appointed an interim resolution professional to take charge of the airline. But a long-term threat may have emerged for both flyers and airlines in the wake of the NCLT order. Aircraft lessors SMBC Aviation Capital, SFV Aircraft Holdings, and GY Aviation Lease have challenged the NCLT order that admitted Go First's plea for voluntary insolvency. And the National Company Law Appellate Tribunal will pass an order in this regard on May 22nd. SMBC Aviation's submission before the NCLAT is that it had terminated the lease prior to the commencement of Go First's insolvency process. Thus, as per the Cape Town Conventions, to which India is a signatory, the airline cannot fly and operate the aircraft concerned. The advocate representing the interim resolution professional said that the notice of termination of lease by the lessors was a way to defeat the insolvency proceedings. SMBC also told the appellate tribunal that the Indian aviation sector is seen as a risky jurisdiction in light of the fate of Kingfisher and Jet Airways, and Indian operators were paying a premium to take aircraft on lease as a result. SMBC warned that the admission of Go First's petition would further shake the confidence of the international aviation industry. All of this has led to the apprehension that this could lead to higher risk premiums, which would mean higher lease rentals for other domestic airlines too, and the ultimate result could be higher ticket prices. But data from aviation analytics firm Cirium also shows why India is a critical market for lessors. Sale and leaseback deals accounted for 75% of plane deliveries from 2018 to 2022 in India, compared with a global average of 35%. The demand from Indian carriers is also expected to be for over 2,200 aircraft in the next 20 years. Against this backdrop, what will be the long-term impact on airlines and passengers if the NCLT order is not quashed?
Nothing is going to happen. I don't think the lessors are going to be increasing the lease rentals significantly, and the increase in the lease rentals, even if they are going to be, let's say, probably 0.25 or something like that, will not have a significant impact on the passenger fares. Now, the differential for an airline to access debt in the market. So let's say pre-COVID, the debt was if as an airline you would get a debt at, let's say, 9% on USD, and the sale and leaseback or the leasing you were getting at about 6.5%, 7%. So you had a differential of 200 basis points or 2%. But now that has completely changed. The room that is available for the lessor to increase the premium has drastically shrunk down to almost 1.5% or 1%. So if they try to increase the premium, it is going to just tip off to the extent where someone like a Tata or an Indigo can just go and take a debt in the market, and that is still going to be at the same rate as what the SLB is going to be or the lease is going to be. So there is an upper limit to which these guys can increase the premium.
In light of the recent NCLT order, that brings in an additional element of uncertainty for lessors. But we see that that may not have a significant impact on the Indian airlines, at least on the large Indian airlines with a solid balance sheet. We do not see higher lease rentals for them because of this order going forward. New startup airlines and small airlines may see the lease rentals going up, to some extent.
And will the tussle between Go First and the lessors lead to a structural change in India's civil aviation sector?
What NCLT has done is not at all different from what the laws in UK and US are. In US and UK, when you have airlines going through a Chapter 11, they do have the ability of retaining the aircraft. The lessors cannot take the aircraft back. I mean, forget about the lessor. The banks cannot take the aircraft back. It just showed that we matured fast enough as compared to what the other lessors were hoping for. But what it has definitely caught the Indian aviation from that perspective, and I think the other airlines would actually start looking at it, is the risk of having a significant portfolio being under lease structure. So my view is that you will now start seeing a sort of a balanced structure where you would have aircraft under lease as well as aircraft under ownership. And there have been multiple ownership models that have come across in the aviation sector. That is the change that you will start seeing.
Citing sources, Business Standard has reported that the centre could expedite the bill that implements the Cape Town Convention and Protocol, making it easier for lessors to repossess planes, as the bill could have primacy over the insolvency law. It remains to be seen whether this will appease the lessors, as some in the industry believe it will, and bring relief to Indian airlines, which pay a big chunk of their revenues as lease rent.
Boeing, meanwhile, has said that Indian airlines are likely to require over 2,200 aircraft in the next 20 years, and the Go First episode can't knock the growth trajectory of India's civil aviation market off course. Moving on, one of the largest conglomerate of the country, Larsen and Toubro, has been flying high for decades now, leaving behind a trail of development projects and much more. Recently, it has seen a change of guard. So where is L&T headed from here? Tushar Verma has the answer.
India's biggest construction company, Larsen and Toubro, is seeing a change of guard. Anil Manibhai Nayak is hanging up his boots after serving the company for about 58 years. He became the chairman in 2003 and remained at the helm for the next 14 years. And in 2017, Nayak stepped aside from executive responsibilities and took over as group chairman. His tenure comes to an end on September 30. The new chairman, S.N. Subramanian, is also a L&T veteran. He had taken over as its CEO in 2017. This churn is coming at a time when L&T is increasingly diversifying and branching into high-tech sectors. Founded by Danish engineers Henning Holk Larsen and Soren Christian Toubro in 1938, L&T has delivered prominent infrastructure projects such as the famous Bhakra Nangal Dam. L&T's overall market capitalization is around 3 trillion rupees, and its core engineering and construction operations account for about 65%. The new leader is expected to bring changes and provide new directions. So, what are the key issues that Subramanian will have to deal with?
I don't think a large conglomerate like L&T, especially which is in the infrastructure sector, is going to change its business overnight, right? If anything, L&T has two opportunities in front of it. One, riding on the India infrastructure wave over the next 5-10 years. Two is obviously expanding globally. It is already doing a lot of work in the Middle East, in other Southeast Asian countries, etc. But I think it could press the accelerator much more. And obviously, newer opportunities also open up, like setting up data centers, setting up these kind of infrastructure which are different in nature.
Barring the pandemic year of 2021, both profit and revenue of the company have been on the rise for a while now. From FY19 to FY23, its net profit after tax deduction has increased by 30%, touching about 12,600 crore rupees. Similar is the trajectory of revenue from operations. It has seen an increase of nearly 36% from 1.35 trillion rupees in FY19 to 1.83 trillion rupees in FY23. So, what more can L&T do to expand its footprint, especially with a new chairman in place?
They need to deepen the thrust. They need to bring information technology and artificial intelligence to the table. There are certain things, for example, the nuclear plant, nuclear energy plant. Very few companies in the world can be awarded an EPC contract. Perhaps in our country, the only EPC contractor who can even dare to accept such a contract is Larsen and Toubro. So that's where L&T will go. They built a very challenging tunnel way up there in Kashmir. There is huge history behind L&T and a great opportunity looking forward.
Although a big company, L&T does not have a clear promoter in place. According to its FY23 report on shareholding pattern of the promoter and promoter group, domestic institutions such as mutual funds and insurance companies held 38.77% of all shares. Foreign portfolio investors hold about 25% of all the shares. The rest of the shares are held by non-institutions such as the Employee Provident Fund Organization. L&T has been involved in bidding and takeover wars since its inception. In 1989, Reliance made a hostile move to take over L&T. The Government of India intervened and made Reliance a passive investor. In 2001, the Ambanis sold their stake to Birla Group, which was eyeing L&T's cement business. After a prolonged tussle, the Birlas withdrew in exchange for L&T's cement business, which is now known as Ultratech Cement. Going forward, what challenges will L&T face?
Traditionally, L&T has been a company which is focused on infrastructure, and its return on equity has been fairly low in that sense. So from that perspective, it had, even to this day, it is in the early teens only, 12.5%, etc. So I would think that, and it had set up divisions like LTI, Infotech, and technology services, etc., which were high return on equity, but those now have been spun off as different companies. So L&T's challenge would be to find a new business lines which have high return on capital and return on equity.
Experts say that L&T has stood the test of time. Its main challenges now will be diversifying and growing further in emerging technologies.
Despite a lower than estimated Q4 FY23 earnings, several top brokerages like Jefferies and Nuvama have retained their positive views on L&T stock. Moving on. At 6,480 crore rupees, net inflow into equity mutual funds hit their lowest level since November last year. The flows declined even as debt funds saw inflows of over 1 trillion rupees. So what caused this sharp drop in equity mutual fund inflows? And what is the road ahead? Nikita Vashisht answers these questions in our next report.
Flows into equity mutual funds saw a sharp decline in the month of April. Data provided by Association of Mutual Funds in India shows that gross inflows into active equity mutual fund schemes dipped 34% month-on-month to 25,400 crore rupees in April. Consequently, the net inflows dropped around 68% month-on-month to 6,480 crore rupees, their lowest level since November last year. Analysts attribute the steep decline to a number of factors, including strong seasonal inflows in March and few new fund offers.
There were no new NFOs in April compared to the previous month. especially in the dividend yield category and the sectoral category. These categories experienced a significant decrease on month basis because there were no new NFOs here and there was substantial NFO collection in the month of March. Additionally, flows in the equity linked saving funds, which is the ELSS, also typically have much higher flows in March as compared to April. This is more seasonal than structural. Typically, you see a lot of people, doing their ELSSs in the last month of the year. Furthermore, there were also a few closed-ended funds which matured in the month of April, which again led to lower net inflows. So that I think these are main reasons why you saw a big month-on-month dip.
Segment-wise, large-cap mutual funds clocked inflows worth just about 53 crore rupees in April, down sharply from inflows of 911 crore rupees in March. On the contrary, small-cap MFs attracted a net inflow of 2,182 crore rupees and mid-cap MFs saw 1,791 crore rupees worth of investments. That said, total asset under management for the MF industry rose 5.6% month-on-month to 41.6 trillion rupees in April. Going ahead, analysts expect flows into index funds or large-cap mutual funds to outpace other offerings.
Until 2022 or even till end of April, the YTD FII flows are negative. 2022, it showed had a very high FPI outflows. So when I look at the foreign portfolio investors, their portfolio, that would predominantly be comprised of large caps. So more than what the underlying performance of those companies, it was more of a flow thing, where the foreign portfolio investors had a higher share of investment in those large cap funds, and therefore there was selling pressure, and hence the returns were muted. So that is one factor which you would see some bit of revival, and therefore you would see the performance of large cap funds coming back.
Thomas says large cap companies have better earnings visibility, stable balance sheets, and better risk reward, keeping their funds better placed than others. Meanwhile, Sahil Kapoor of 361 Wealth expects performance trend to remain mixed across various asset classes.
So I see short-term funds, money market funds continue getting flows. Long-term debt and medium-term debt funds will struggle post the new tax changes. So I think target maturity funds will not see the flows they were used to seeing earlier. A lot of the debt money might move into hybrid funds. So I think hybrid funds will see good flows going forwards. In terms of large cap funds, I think they will continue to see outflows at the expense of an index funds. So I think passive investing will definitely be more dominant in the large cap space. But as mid and small cap funds will continue getting money.
In nutshell, inflows into mutual funds could slowly gather pace as stability returns to markets. Analysts expect large cap funds, hybrid funds, and shorter duration debt funds to be among the pockets which may see higher flows. Today, on May 17th, last leg of corporate earnings and global sentiment will dominate the market trend.
Once a favorite investment option, debt mutual funds seem to have lost their charm after the government withdrew long-term tax benefits it used to enjoy. But as they say, where there is a will, there is a way. High net worth individuals are now turning to private credit funds. So what are they? Raghav Agarwal decodes it for you.
India is increasingly becoming a major attraction for global companies in the private credit space.
Last week, Bloomberg reported that Washington-based Carlyle Group is in the early stages of exploring an entry into India's private credit market via its existing private credit funds. Nippon Life is planning to launch a $244 million Indian private credit fund. Apollo Global Management, Oaktree Capital, and Blackstone Inc. are already competing for these deals here. But what is a private credit fund? But before that, let us understand what private credit is. Private credit refers to loans that are given to privately held companies that are unable to access the traditional loan markets. The repayment of such loans is usually secured by a pledge of the borrower's assets. Private credit funds are thus actively managed pools of money that invest primarily in loans to private companies. Here, investors combine their capital and allow the manager to make investments in loans to various companies. They may also purchase a loan from the secondary market. The main goal, like all other investment funds, is to earn profits. When an investor wants to invest in a private credit fund, they receive a private placement memorandum, which has details like the terms and strategy. Then, if they want to invest, they have to sign a fund's partnership agreement, which highlights the rights and fees charged. These funds are not listed on exchanges, and more often than not, only high net worth individuals and institutional investors invest in these funds. There are majorly two ways in which funding to a private company takes place: internal and external. In internal funding, the company can issue additional share capital and get deposits from directors or their relatives. In external funding, the money is raised from banks, venture capitalists, private equity firms, and in some cases through crowdsourcing. Private credit funds too fall under the external source of funding. The main difference between the two is the ownership of the borrower. In private credit funds, the lenders do not get any share in the ownership of the borrower. However, the private equity funds ask for a share in the company they are lending their money to. PE funds also typically have a limited lifespan, but private credit funds do not. According to a report released by EY earlier this year, 76% of high-yield fund managers are bullish or very bullish on private credit investment in India over the next 2 to 3 years.
I will achieve, I will fly high, in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Vedanta Group 2 has turned to credit funds such as Farallon Capital to raise over $1 billion it needs for repayments. That's all for today. For more news and analysis, please log on to business-standard.com.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.